A mortgage credit certificate is a special program for first-time buyers that will allow you to save as much as $2,000 a year on your federal income tax for as long as you live in the house, and it going to help you qualify for the mortgage by helping give you that credit back as income. This is an incredible program. Uh, Mortgage credit certificates are not they're going to be a lot more popular now than they have been in the past, and it's a first time home buyer product. A lot of loan officers don't know about these programs because they can't make money off of them, so they don't talk to you about them. I have over 20 years experience in the mortgage industry. I've done a lot of these programs because I like working with first time home buyers and I like working through the housing finance agencies. So in this episode today, I'm going to unpack what a mortgage credit certificate is, and why it's important to you, how it works, where you can find one, and how you can figure out whether or not you can use it. And then in the next video that I'm going to do, we're going to break down how each agency, Fannie Mae, Freddie Mac, FHA, VA, and USDA, how they view mortgage credit certificates and how you can use them to qualify for those loans. So let's start with just explaining what a mortgage credit certificate is. So first of all, this was a program that was established during the Deficit Reduction Act of 1984, and then it was modified a couple of years later on the Tax Reform Act of 1986. And essentially what it is it's a special federal tax credit for first-time home buyers. It's not a tax deduction. So all right. I was wondering how I'm going to unpack this and how I'm going to explain this. And you'll probably see me repeating myself here a couple of times. Because this stuff is a little bit interesting. So essentially what you're doing, so when you buy a home, your mortgage interest, the interest that you pay on the mortgage in some situations is a tax deduction. Now, a tax deduction is when you reduce your taxable income by the tax deduction amount. So let's say, for instance, you pay $10,000 in interest on your mortgage on the house that you just bought. And that's going to be an example I'm going to go through later. You have $10,000 worth of interest. Now, if you made $50,000 last year on your taxes, and you itemize your 1040 tax returns, you can take a tax deduction for the mortgage interest. So instead of paying taxes on $50,000, you're only paying taxes on $40,000. That's a tax deduction. Now, what a mortgage credit certificate is it's going to take a portion of your mortgage interest and it's going to convert it to a dollar for dollar tax credit. And that tax credit could be anywhere as high as $2,000 a year. So if you owe $2,005 in taxes at the end of the year and you have a $2,000 tax credit, you now only have a tax bill of $5 because of the tax credit. Remember, as opposed to a deduction, which a deduction comes off your income, then your taxes are determined. I can already tell this is going to be a confusing, this is going to be a challenging topic, but I promise you everything you need to know is in this video, and it does make perfect sense. And more importantly, if you're watching this video, you know how to get in touch with somebody that understands these programs and can help walk you through it. So a mortgage credit certificate is typically 20% of the interest paid on the mortgage. I've seen as high as 25% through a county or through a city, but the IRS mortgage credit certificate program that was developed in 1984 and 1986 is 20% of your mortgage interest. Now, there is a direct and immediate benefit when you apply for a mortgage credit certificate. Now, you apply for the mortgage credit certificate at the time that you apply for the mortgage with your lender. The maximum credit is going to be $2,000 a year. So 20% 20% of your mortgage interest. If your mortgage interest that you pay is more than $10,000 a year, your maximum tax credit, mortgage credit certificate tax credit, is only going to be $2,000 a year. So you will know exactly what your tax credit is going to be upfront because it's based off of your loan amount. So if you know what your loan amount's going to be, then you know what your mortgage interest is going to. Well, if you know what your loan amount is and your interest rate, you know how much mortgage interest you're going to pay. Then you know what 20% of that mortgage interest is. And so you know exactly what your credit is going to be every single year. You are encouraged to reduce your W-4 withholdings by the credit amount. You talk to your CPA or your accountant and you say, I have this $2,000 tax credit. I want to adjust my withholdings so that you're not taking that $2,000 out because I have this tax credit. So I don't want it pulled out of my paycheck. So that's going to result in you actually bringing home more money every single month as soon as you buy a home. That, I know that sounds crazy, but this is why this program is so incredibly cool. So you're not only going to reduce your W-4 withholdings on your paycheck, so you're going to take home more on your paycheck, then you're going to take that credit, that annual credit, and you get to divide that by 12, and it's used as income when calculating your debt to income ratios. So if you have $10,000 in mortgage interest, and we're going to go through this, I'm going to give you these examples in this video. But if you take this, actually, I'll wait until I'm going to do it. I think. Let me see. So how do I get a mortgage credit certificate? So mortgage credit certificates are available through your state housing finance agency. So what I would Google is your state name, housing finance agency, use the acronyms HFA and MCC. So MCC is a pretty popular term that stands for mortgage credit certificate. So if you type in Colorado Housing Finance Agency, MCC, you should be able to pull up the mortgage credit certificate program. Also check your city and county for MCC programs. Now, when I was an originator, I worked out of California. We had some city and county MCC programs that would go up to 25%, not just the 20%. So we had different programs, and the State Housing Finance Agency would quite frankly tell us, listen, if you can get a higher credit from this place, you should use this mortgage credit certificate. Your lender is going to apply for you. So it's important that you are working with a lender that has access to mortgage credit certificates. Not every lender is going to have access to mortgage credit certificates. Now, when I say lender, that's a little bit confusing because you're talking to a loan officer. Now, if that's a mortgage broker, like what I am, I have a lot of different lenders that I can work with. So if you want a mortgage credit certificate and you call me a mortgage broker, I'm going to go through all of my lenders and I'm going to find the lender that is approved to offer the mortgage credit certificate that you're looking for. And we're going to do business with that lender. So if you walk into a lender, you walk into a bank and you say, I'd like a mortgage credit certificate. And they say, well, we don't offer that. They just don't offer that. That doesn't mean that it doesn't exist. And it doesn't mean that another lender couldn't give you this mortgage credit certificate to help you qualify to save you money for as long as you've been in your home. So the lender will apply. There's no paperwork that you have to do. The lender's going to reach out. They're going to apply. They're going to get the certificate. They're going to get everything that they need to approve this and to do the calculations to help you qualify for more mortgage amount. You also must be a first-time home buyer. You can only get a mortgage credit certificate, that tax credit, is you're eligible to take that tax credit for as long as you have a mortgage on that home. So if you take a 30-year loan out, you could have that tax credit for the next 30 years. If you refinance, you can keep the mortgage credit certificate. There's stuff that you need to do to make sure that you keep it, but you can keep that mortgage credit certificate, and then you're going to continue to get that tax credit for as long as you live in that house and as long as you have a home. But you can only apply for the tax credit when you're a first-time home buyer. So again, this is one of the reasons why we created Find My Way Home in the first place, because so many loan officers, because they don't get paid off of giving this to you, off of helping you with this. Actually, in some cases, they might get paid less because they can only work with certain programs that are designed to help low to moderate income first-time home buyers, and mortgage credit certificates are one of them. So some loan officers don't even want to deal with you. They don't think they can make enough money. And that's why they don't tell you about this. So hopefully you're a first-time buyer, you're doing some Google and some YouTube searches, you're finding this video, and you realize these benefits are available to you whether your loan officer is telling you or not. So the MCC limitations, there are some limitations to this. This is not a pie in the sky kind of program that everybody's going to benefit for. Mortgage credit certificates might not be for everybody. Not everybody's going to qualify for it. You might even be in a situation where it doesn't benefit you. A perfect example is that the credit cannot exceed the actual taxes owed. So if you only owe $1,000, but you have a $2,000 tax credit, you're not getting that $1,000 back. You can, however, roll over the unused credit forward up to 3 years. But the chances are, unless you get a much bigger mortgage with a much higher mortgage interest payment, you're not going to be able to use that. So there are some limitations. If you only owe $50 in taxes, you're only going to be able to use $50 worth of tax credit, but you're not going to have any taxes. You're not going to pay any taxes because the credit offset it. And this is primarily targeted towards low to moderate income first-time home buyers. So income and sales price limits are going to be very, very common, and they're going to vary from state to state. So again, you look up the State Housing Finance Agency, look up their MCC program, and all of your qualifying guidelines will be there. Let's see. So here's an example. Here's an example of a mortgage credit certificate. Now, this example is actually the example that was given by the IRS. This is on the IRS website. So this actually, maybe it's on the FDIC website. I'm not sure. So this is an official tax website. So this is the example that they gave, and I really liked it, so I'm going to use it here. So Joe and Sylvia are buying their first home, right? What a lovely story. Their annual income is $50,000. The mortgage interest on the first year of their new home is $10,000. Again, this has been highly simplified so that the math is easy. Without the MCC, without the mortgage credit certificate, they're going to be able to take a tax deduction of $10,000 for the interest rate deduction if they have enough deductions to itemize. Now, if they don't have enough, if they're not itemizing, they're taking the standard deduction on their 1040s, because in a lot of cases, the standard deduction could exceed the mortgage interest deduction. So you would just take that particular deduction. So if they didn't have a mortgage credit certificate, they're going to reduce their $50,000 of income to $40,000 worth of income, and they're going to be taxed on that because they have a tax deduction. Now, in this particular case, they are using a 20% mortgage credit certificate, and they've maxed out the benefit of $2,000 per year. So $2,000 is the year. So Joe and Sylvia can use, so remember, they have $10,000 in mortgage interest that they're dealing with. If they take a $2,000 mortgage credit certificate, then they can use $8,000 of their $10,000 in mortgage interest. They're going to use $8,000 of that to reduce their taxable income. So they're going to reduce their taxable income from $50,000 to $42,000, and they're going to pay taxes on the $42,000. And they're going to have a $2,000 dollar for dollar tax credit to apply to the taxes that are owed because they have this mortgage credit certificate. So that's how it works. A portion of the mortgage interest is converted from a tax deduction, which is reduced from your income, and then the tax calculation happens, to a dollar for dollar tax credit at the end of when you did your federal income taxes. If you owe $2,001 in taxes, you have a dollar for dollar tax credit. So your tax liability is reduced to $1. That's a difference between a deduction and a credit. So here's another little graph that they kind of give here, and they say that with the annual income without an MCC, we just went through this. They take the $10,000 deduction. Their taxable income is $40,000. Their federal income tax on this is $6,000, and that's what it looks like without a mortgage credit certificate. Now, with a mortgage credit certificate, they have annual income of $50,000. They have the mortgage interest deduction. They're using 80% of the total because they have a 20% mortgage credit certificate, remember? So instead of $10,000 deduction, they're taking an $8,000 deduction. Their federal income taxes are calculated off of the reduced a net, I guess you would say, income of $42,000. So the federal income tax is $6,300 minus the mortgage credit certificate. So the total taxes owed are $4,300. Their net gain on their first year is $1,700. So they paid an extra $300 in taxes because of the deduction, but they gained $1,700 because of the dollar for dollar $2,000 tax credit. That's huge, folks. It doesn't sound like a lot. It's a little bit over $100 a month, but I'm telling you, I would way rather have that $1,700 in my pocket than in Uncle Sam's pocket. And I hope you agree with that. So I'm going to try to make this Homer simple for everybody, because this stuff is crazy and it's complex. So again, we're going to take a $200,000 loan at a 6% interest rate to qualify for the max. So that's a little bit over $10,000 in interest. Our max tax credit is $2,000. We're going to adjust our withholdings from our employer, and we're going to say, hey, I'm paying $2,000 less in taxes this year, so reduce what you take out of my paycheck because I don't have to pay that extra $2,000. So I'm going to take home more every single month. You're going to take a tax deduction of $8,000. So you're going to reduce your taxable income by $8,000. You're going to apply the $2,000 tax credit to the tax liability that's owed. And then this is where it gets really cool. You're going to take the $2,000 tax credit. You're going to divide it by 12. And you're going to be able to add $166.67 to your income to qualify for the mortgage. I know that sounds crazy. This is really complex. And even Homer's drooling a little bit as I'm trying to explain this. So again, a mortgage credit certificate takes part of your tax deduction from your mortgage interest that you're entitled to as a homeowner. It converts it into a tax credit. That tax credit offsets your tax liability and can be used as income to show that you make more money so that you can qualify for a higher loan amount. This is really an unbelievable program. So how long can you benefit from your mortgage credit certificate? Well, you can continue to take the annual tax credit for as long as you're paying mortgage interest on this home. And this can be transferred with a refinance. If you refinance your mortgage, you can keep your mortgage credit certificate in place. It requires doing paperwork. It requires making sure that that the proper paperwork is being done so that you can retain your mortgage credit certificate. So you always want to talk to your lender. Again, if you're dealing with a lender that doesn't do this paperwork properly, you could be losing out on 10 or 20 or 30 years, depending on what the refinance is, worth of mortgage interest, worth of tax credits from the mortgage interest. So it's really, really important who you talk to. Now, there is a catch with mortgage credit certificates. this is interesting. So I don't know where this came from, but like in California, they straight up said, we have never seen anybody get this recapture tax. The recapture tax, there's three things that have to take place. All three things have to be present in order for you to have to pay a recapture tax. The first is that if you sell the house within 9 years. So if you stop living in the house within 9 years, if you know you're going to live in the house more than 9 years, you never have to worry about the recapture tax. It's not going to happen. Then you have to earn significantly more than when you bought the home. So at the time that you sell, if you sell in less than 9 years and you're making significantly more money than when you bought the home, and if you make money from the sale of the home. So if you're earning equity on the sale of the home, if all of those three things take place, then there could be a recapture tax. And the recapture tax is 6.25% of the original principal balance or 50% of the gains on sale, whichever is less. Now, this sounds drastic. Like it sounds like it would cause you to pause. Most housing finance agencies report that this never happens. The recapture tax doesn't happen. And that's okay for most housing finance agencies. Some housing finance agencies have gone so far as to put in place a recapture tax reimbursement program just in case you meet all three of those criteria. That's Maine, Massachusetts, Connecticut, Idaho, New York, North Dakota, Ohio, and South Dakota. Currently, if that recapture tax happens to happen, if it takes place, if you do get hit with that, they have a reimbursement program that will pay for that. So I would not worry about the recapture tax, but I would be aware of it and I would ask as many questions as you possibly can until you're fully satisfied that it's not going to be a risk for you. Now, so this has been an overview of what a mortgage credit certificate is. Next week, I'm going to release a video on how each agency treats a mortgage credit certificate. How do you qualify for using a mortgage credit certificate with Fannie Mae, Freddie Mac, FHA, VA, and USDA. My point here isn't to sell you on mortgage credit certificates. It's to let you know. Now you know that this exists. Now you are empowered with one more option that's going to help you maximize the benefits of home ownership. Now, whether a mortgage credit certificate, whether you're even eligible or whether it's even right for you, I don't know, but at least you have enough information. And I just want to let you know at Find My Way Home, we are a network of mortgage professionals that we consider ourselves guideline geeks. We love this stuff. We love solving problems. And not only do we love solving problems, we hate the fact that you can't get answers with a call center and that they're telling you no when it might not be no. It's either not now or they just made a complete mistake. They don't know the guidelines. So we are here to help you. So how can we help you? There's a lot of different ways. If you're seeing this on findmywayhome.com on the website, you can comment in the comment section below. If you're watching this on YouTube, you can leave a comment below. You can also visit findmywayhome.com. You can either find a loan officer on our directory. You can look by state to see who's licensed in your state. You can reach out to them directly, or you can ask us to connect you and introduce you to a loan officer that we've already vetted, that we know, like, and trust, that we are happy to introduce to you. Every Wednesday, we're going to start doing a live question and answer on Wednesdays. Just check the schedule, check the channel, make sure that you're subscribing to this YouTube channel so that you're getting notifications when we go live. I would love to say we're going to do it every Wednesday, and I would love to say that there's not going to be any gaps and that we're going to start this Wednesday, but I don't know. I'm just starting to launch this again. So subscribe so that you can be notified if we do that. And then we have more links in the details below. You can click the link to go to Find My Way Home or to be introduced to a loan officer that we know, like, and trust that can help you. So I hope this was helpful. This is a tough subject because there's a lot of folks that have second jobs right now. And I don't want an inexperienced or lazy loan officer prevent you from qualifying for a mortgage just because they don't understand the guidelines. So I hope this was helpful. If you have any questions, feel free to reach out and ask. We are more than happy to help. And I hope you have a great day. Thank you. Bye.